Welcome to day 2, where you will learn how to develop the mindset to ensure you control your emotions and respect the rules. Trading can be an excellent career because you only have to rely on yourself. No staff, no customers, no stock, invoicing. However, if you expect to get rich quickly, find something else. This is not a path to quick riches, no matter what you see all over social media. A realistic approach to building an income is by focusing on slow and steady account growth. Once you are consistent and you can trust yourself, compounding will allow you to accelerate gains. Capital preservation is the key to trading success, of course. We all know that. If you don't have any money in your account, you can't trade. To maintain discipline and maximize success, it's crucial to preserve mental capital. This is the psychological and emotional fortitude necessary to make rational trading decisions and avoid detrimental behaviors. When you make a large loss, it's not just a loss in monetary capital that impacts you. Your mind goes into a state of confusion. Your confidence is destroyed. You then miss profitable trading opportunities while you're nursing the increasing losses. It takes a lot longer to win back that money than it did to lose it. We all know it's just not worth getting yourself into this position where you suffer the frustration, the anxiety, and the self-doubt. But what can you do to control yourself? I'm going to explain to you my 6 key pillars of trading psychology. I want you to understand what I mean by mental capital. This refers to the psychological resilience and the mindset that is required to navigate the ups and downs of day trading. It's distinct from account capital as it focuses on the impact of losses on subsequent trading decisions. When a loss affects your trading behavior, it becomes a mental capital limit. Preserving mental capital is vital as it influences various aspects of your trading, including your entries, your targets, your risk management, and the ability to trade with confidence. Traders can minimize external influences and create an environment within their own minds which is conducive to sound decision-making. The third one is the pitfalls of winning trades. Now, you wouldn't think that would be a problem, but while losing trades are commonly associated with depleting mental capital, because of course they make you doubt yourself and hurt your confidence, it's essential to acknowledge that winning trades also pose risks. Why is that? A winning trade often instills a sense of ownership and accomplishment, tempting traders to re-enter the market prematurely. You really want that winning feeling again, but to preserve mental capital, it's crucial to redirect that energy and excitement generated by a winning trade away from the market. So number 4, don't lose control. When you have a winning trade, don't get overexcited. Don't look to rush back into the market. I know I've done that, and we all know how it ends when you're overconfident. You need to avoid the highs and lows of trading. Number 5, it's vital to recognize that each trade is independent of previous outcomes and to approach every decision with objectivity and adherence to your trading plan. Emotional trading is often driven by fear and greed, as we know, and that can quickly deplete your mental capital as well as your account capital, your monetary capital. It's important to set targets, not only targets for each trade, but you also have to set targets for your day and for your week. So if you've had 3 winning trades and hit your profit target for the day, stop. There's nothing wrong with that. It might be midday. If you've hit your target, stop. Pat yourself on the back. You've worked hard for that. You did the analysis. You followed your rules. You should feel that you have strong mental capital. Take the profit, move on to the next day in a positive frame of mind. The same goes for a week. You should have a trading target for the week. Now, if you've hit that target by Thursday, there is no point in trading on a Friday. If things go wrong on the Friday, it'll ruin your weekend. You'll spend the weekend processing what happened. Quit on a Thursday, take the Friday off. You need to feel positive about what you've accomplished. Then you'll be in the right mindset to start trading again on Monday morning. Spend the weekend going over whatever you did right to reinforce those good habits. The other aspect which can destroy traders is revenge trading. Maybe you feel like you've missed a trade that you shouldn't have missed. Maybe you've taken a loss that you didn't feel you deserved to take. Maybe you hit your stop loss just before the market reversed, turned around and went in the right direction. All of this can lead to a heightened state of frustration, and it leads to revenge trading when you feel like the market owes you something and you jump back into a trade. You're trading irrationally, irresponsibly, spontaneously. You're trading out of anger. You've lost control of your emotions. We're going to look at measures that you can use to avoid these 6 points I've brought up. Here are some of the warning signs that you're trading and that your mindset is not under control. You must maintain awareness of your mental state. If you find yourself continuously monitoring your trades, excessive trade watching, it's indicative of the fact that you're probably taking too much risk, and it's going to lead to anxiety, probably frustration. Your mental capital is at risk. You can't get yourself into that state of mind. It's not worth overtrading or over-risking on your trades. We're going to address that later on when I talk to you about how I execute and monitor clean trades. When you find yourself excessively focused on short-term fluctuations and constantly questioning your decisions, it's time to reassess and step away from the market temporarily. Here are key ideas that you need to avoid overtrading. Feeling that the market owes you something and it's taken money from you, which leads to revenge trading. Fear of missing out, and that's a big one. A lot of traders that I speak to have this fear of missing out. It doesn't matter if you miss a trade. You will miss trades. We all do. I miss trades by 1 or 2 pips all the time. I set my entry point, the market gets close, it doesn't quite get there. Probably every week I miss a trade by a few pips. It happens, and there will always be another trade idea around the corner. Stick to your strategy. If you don't, your risk versus reward strategy will be blown out of the window. And we're going to talk about that in the next lesson.